right. Well, thank you, Norm, for that warm up for what I hope to be able to talk about this morning, and that's the different levels and some of the terminology within FBS, referring to the report levels. And as we alluded to, FBS has a lot of strengths, but those strengths also create the complexity, and report levels are definitely be considered in that realm of the power, but yet some of the confusion that takes place. But I think it's important as I work with people and try to train new clients on FBS. I think in terms of two different concepts. One is cash exchange, is where we adjust our reporting to only match when cash or the AR or APs are offset when cash is exchanged. The second concept that we're talking about is the different report levels. And we've all seen those in terms of the cash, accrual, management, and marketing. And as we go through this, I will admit that there's confusion on terminology between what we think in theory, what we read about, definitions, versus how FBS maybe has things labeled. So I'll try to clarify some of where, at least where I think the terminology might need to land. And then as I work with people, especially new users, my way of teaching or instructing is to enter an example, enter a journal entry or enter a AP, and then go look at the report and see the effect of that report. So as we go through this, maybe somewhat elemental to some of us, but I also hope that we kind of teach this in a different way than what's been how I've seen it taught here. So first of all, some basic definitions. First is cash reporting. Basically, we got a chat here. Okay, Norm. Okay, I'll check. Okay, so Norm's going to take care of that. So the definition of cash, in my mind, is when revenues are received as cash and when expenditures are paid out in cash, either through some form of cash transaction. Cash accounting, from a balance sheet perspective, lacks your AR or APs. There's no accounts receivable or accounts payables reported on a cash balance sheet. So why are we moving forward? Okay, accrual accounting. Let's see if I can move this. Accrual accounting is, the ultimate goal of what we try to get to, and that's where we try to meet the matching principle of accrual accounting, where we match the costs with revenues, and revenues are recognized when they are accrued. So if you sell you could take some corn into the local market and the delivery has been made, but you haven't received the cash yet. Well, you need, in theory, from an accrual perspective, you need to record that cash. You need to record that delivery as an accounts receivable. So you've got the accrued revenue booked on your balance sheet. Conversely, accounts payables the same way. Whenever an expense is incurred, you should record that expense. Okay, where this definition may flip a little bit on us is that expenses are reported when they are best matched. So in the terms of like a growing crop, well, here we are, we have fertilizer and seed put down in the spring, and they're generally expensed out at the cash level, but from accrual level, we haven't sold the crop, we haven't recognized any revenue yet. So those dollars need to be moved or whipped to the to the balance sheet. So that's the concept of matching is trying to associate those costs that when the transaction is actually recognized as revenue. So a growing crop, those dollars need to be represented in the accrual balance sheet. In this way, your net income is more reflective of reality. Balance sheet's a little more complete. We've got accounts receivables and payables and accrueds placed on. And generally, in the CPA world, the GAAP world, this is kind of the goal that we try to get to for GAAP accounting. So Norm is, we've seen this pyramid. Norm uses it quite often in his presentations. So I want to try to match up the FBS terminology with these report levels. And so first of all, cash accounting, in my mind, the cash accounting terminology is just what I just went through. In my mind is the tax cash level with option 3 cash exchange. And that would be represented by those menu items on those menu items. In terms of accrual, I think of that as the accrual report level with option 1 cash exchange. That's the true matching of revenue, true matching of expenses with revenues. Again, the report options and toggles to get to what I think is more of an accrual-based reporting. So what is tax cash option 1, cash exchange option 1? Because that's where most people probably run reports at. As I was doing some research for this, I came across the term of modified accrual accounting. And I remember this term back in my college days. But basically, it's the ability to manage accounts receivables and all your basic journal entries, but not have your expense adjustments back to the balance sheet. So it's kind of a modified accrual accounting. And this is a term that I did find as I did some research on this. So let's go through an example. Again, I like to go through entry by entry and explain to how the dollars show up on the various reports. And let's say we have a $20,000 rent expense that we book in March. Okay, so when we run the reports in March, we see that $20,000 booked as a payable. Okay, but what happens when we pay 50% of it in April? So when we run the option 3 report, cash exchange option 3, you can see that the 10,000 shows up in the month of April. So there again, you got some reporting differences based on when the cash was paid. So cash exchange, again, it's a difficult concept. But some of the things that I've tried to encourage just to avoid communication issues. One is if you have capital expenditures or anything on the balance sheet that's sitting as accounts payable, I try to avoid mainly because of communication issues. And one of them is capital expenditures. If you go out and buy a piece of equipment or a major repair and it hasn't been paid for, I try to encourage putting that into a construction in progress account, kind of a temporary account before it's truly capitalized. That way we have clear communication with the CPA with what's in that fixed asset account. I don't know how many times when we start comparing at the year end, there's some kind of distortion between what the CPA has on its tax depreciation versus what we have in FBS, because somewhere along in the process, somebody ran the wrong report. Another challenge we have with cash exchange is with loan payments. a lot of loan payments come due on say January 1st. Well, I see people setting up loan payments on January 1st, but when they run various reports, well, those balances don't tie out to what the loan account shows with Farm Credit. So again, I try to make sure that at major year, at the year end, that we try to limit the number of balance sheet ledgers that run through accounts receivable payables. I know can't do it all, but I try to watch and manage that. And then the other issue I see on cash exchange is people like to put prepay expenses in as a accounts payable. Well, my question is it truly prepaid if it hasn't been paid yet? In my mind, it's not, but it may be an obligation. Okay, so unique cash exchange, especially as we get into the tax reporting side of things, is inventory for resale, especially for livestock. As FBS, we go through the year, the way of reporting FBS is to run those livestock purchases through an expense account. Well, at the tax level, we want, purchased livestock's not deductible. So we need to move some of those dollars back up to the balance sheet at the cost level. So I have what I call a double flip reversal move. Whoever thought that FBS and gymnastics had anything in common?
Or Daryl Ellis.
Well, I would. But anyway, and the reason we have to do this is to avoid double counting, especially if we're in the inventory valuation, we don't want dollars to show up on the cost level as well as the WIP level. So in my example here, over the bottom right is I have two entries. I got $100,000 going into an asset account at the cash level, and then so when you run the reports at the cash level, what shows up is 100,000, but at the accrual level, I reverse that right back out. So when we run accrual reports, that tax basis resale inventory account is back to zero because it's generally probably already in the WIP inventories.
Which center do you use?
I use a tax adjustment center, so it's always an in and out.
The production center.
It would be something clear outside of cost analysis. So and then the key is to use reversing entries. So on the next day that we're right back to where we want to be. But again, this is something, it's something that a little trick that I used on resale inventories. Same thing for accrued payroll liabilities, especially for those that's using Red Wing payroll. We have accrued liabilities that show up at the cash level. Oftentimes we want to move those to the expense from a tax perspective. So we'll move them to an expense and then reverse them right back to the year-end reporting back to accrual level, just so they show up. So from a reporting perspective, how do we see what's going on at the different levels? There's on the income statement, it's called option 8, and balance sheet, it's option 5. And basically what it does, it shows the different report levels in columns going across. I would only suggest using option 1, the cash exchange option 1. The option 3 to me is not a useful tool when we start looking across report levels. Just the option 1. And the other thing is, this kind of report is more for me as a CFO or controller or somebody that needs to audit and understand the different report levels. I would never give this report to management or to a financial institution. It's more of an internal reporting tool that I use to understand what's going on. Okay, so let's dig a little deeper. How the math behind adjustments. Let's say we start off with this 20,000 lease expense, or rent expense that we booked back in March. And over on the right, you can see that at the cash level, we have the $20,000 showing up. And that value is going to show up on any report level that we run, the 20,000. Okay. Then if we're running the inventory valuation process, at the end of the month, that 20,000 is going to be whipped back out, and it's going to be moved to the balance sheet as an investment growing crop. So on 331, that entry, that 20,000 is going to show up at the cash level, but it's reversed out at the accrual level from an expense perspective, but it's moved to the balance sheet. And I think I have an example of that. So the top entry is just your accounts payable, and then the bottom entry, the WIP change, that's the entry that's created by crop audit inventory valuation, this example, moving it out of expense back into the WIP. And then showing the report, the income statement on the bottom, you can see that we have 20,000 showing up at the cash level, but the other levels are zeroed out. Balance sheet at the accrual level, we all of a sudden have that 20,000 showing up. So that's the process, how this math works, where we start at the cash level and then we add the entry moving up the pyramid. So as I was putting this example together, I was going to introduce you to Lucky Joe, or Lucky Fred, I called him. He's a new farmer, and he wanted to impress his uncle of how well, how well he could do his accounting with his new FBS system. And so he went through a few months, and here we are out in September, and these are the entries that he sees. He's got some fertilizer and seed that's put down, some diesel equipment. Then he's got these inventory adjustments, WIP inventory adjustments. But what is missing on this report? Okay, we just talked about lease expense, that $20,000. Okay, we whipped it out. So when we run a report, that $20,000 is not showing up anywhere. Okay, and this is a real life example, except in this case, I'm thinking of an organization that I was with that had close to $750,000 of lease expense in March. Okay, and when I went to show a March or a quarterly income statement for him, I was questioned on where is that $750,000 of lease expense. Well, it had been paid, it had been booked, but it was showing up. It wasn't showing up at the accrual level. So where is it? So that was one of the first. This is long ago that I experienced this. So working with the programmer, we came up with a WIP line adjustment, and basically this type of adjustment it rolls anything with inventory change into the you see the minus 20,000 for WIP expenses, but it also places it up as rent expense. So at least when we're doing a cash flow or matching, comparing, looking at it, at least we have a gross dollars represented on our income statement. And it avoids the distortion in actual dollars spent because of WIP, this particular line type. Okay, then the other question we had was, here we're creating this inventory adjustment section with a bunch of negative numbers. What do they mean? They're confusing, especially as you're looking at your income statement. What do they mean? So another trick that we developed was where you can hide the detail of individual lines within that report section. So in the income statement setup, under the level, you can select detail hidden, and that will create a report that basically hides all the detail within that section, report section. And I'm just trying to clean up the report because we're all of a sudden, as we do these WIP adjustments, and we're introducing a lot of terminology that is confusing, uh, 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 confusing to the user. So as Joe was, Fred's his name, as he was thinking about this rent charge that wasn't showing up, it occurred to him that he had some owned ground in this little farming operation. So how do you charge or account for rent for his own ground? So it'd be equivalent to his cash lease ground in his crop analysis. So I have what we call an imputed rent charge. Basically, it's a rental income versus a rental expense booked to one's booked to a land ownership center, the other one's booked to the crop. But I always group those in this inventory cost of inventory section because the net is zero. I don't want to inflate the dollars, the rental dollars, from a basic financial transaction. I net them in this inventory adjustment section. Okay, so with that, I want to cover quite a bit of ground here. I want to pause before we get into harvest here. Are there any questions? Am I going too fast and too slow, too basic? Anybody online has questions? Okay, I'll move on then. Hopefully we're about halfway through here, I think. How are we doing for time, Norm?
Right on track.
Okay, so here I put that harvest picture up because I wanted to trigger the harvest season. And when you run through the inventory evaluation process, the system puts in some entries that are hard to understand. And how do we report on them? In this case, we have two fields, and I call this internal buy-sell entry. It basically sells it out of the field, and the marketing center, or finished goods product center, buys that crop. So it's a internal buy-sell, income expense transaction. Okay, so on the income statement, we can see the top line. We create $158,000 of revenue, and then that top line on the expenses is the purchase of it. Okay, so the entries that's made in this internal buy, you can see it affects an expense account that also affects a balance sheet account, growing crop. So what it does is at harvest time, it moves those dollars, the net effect, it moves those growing crop dollars from the investment growing crop ledger into the investment stored crop ledger. There's a series of journal entries that make that transition from growing crop to stored crop. And the harvest process triggers that. So Joe was running his financial balance sheet, but he knew that the market price was much lower. Again, this is a case example. I was just making up numbers, so it may not be realistic. It's 250, but I wanted to show that our cost came in at 158,000, but when we put in our bushels times yield or bushels times price, it's much lower. So how do we adjust it to the lower price, lower valuation? Okay, well, Luke, I'm glad. Is this a question you're wanting answered, is how to adjust that?
Yeah.
Okay, great. So the solution is there's a routine called, if I can get to it, a routine called lower of cost to market. And first of all, you need to make sure that this is installed on your system. It's It doesn't come automatically when you do updates, but I have to ask Sarah to install it or get the code to install it every new release. But there's a module, it's under the crop setup, and it's near the bottom, and it's called lower cost of market. So these would be you set up your ledger accounts, your asset accounts, income, and I use the income accounts because these are adjustments to market, adjustments to price. I use income accounts for those. And then the process is, and this is just 1 month, we can go in and establish the market price. So you see that 250, I'll plug that 250 in, and that'll generate the $142,000. So that creates a journal entry we're calling it the lower cost of market. So we're going to go from 158,000, we're going to drop it 16,000. So we end up with the 142,000 on the balance sheet. Okay, this lower of cost of market entry is put in at the management level. So when we run the balance sheet with the different levels, you can see the accrual is at cost, and then we drop it to 250 at the management level or lower cost level to the real market.
Daryl, can you go back to the setup screen? And there's a lot of confusion about the accounts on that list. Are those your standard WIP accounts? Are there some that are linked and unlinked? What are
those? I use the same accounts as the WIP accounts. They're non-linked accounts.
So the only thing different, these are if you've got flip set up, these would be the same accounts that you've used. Nothing new to be set up, but there's a value of unsold inventory, which is not.
Right. So the income accounts we'll get into a little bit later, but I have those set up as well, in this case, I have them set up as one account. We can set them up as lower cost or at market. But for this example, I just use one account.
So the only additional account here is value of unsold inventory, and then the adjustments are being made at the market value. So
correct.
Layered on top of the accrual entries that are.
Yeah, it's on top of the accrual. Luke, does this help?
Yeah, that's that's a cool module. I mean, I'd have to step through it, and I'm still learning a lot about FBS in general, but this addresses something that I've had to help my dad with the last 2 years of trying to figure out, well, okay, that's what FBS thinks it is, or at least at the accrual or cash level, but the market value is different. So when we're reporting to the bank, like what we think our stored crop is worth, how do we get it to show up in the report? So I'm not having to manually do that, adjust anyway. So this looks like it'll take a little bit of exploring to learn about, but I think that's helpful to see. So
okay, one little caveat as you get into this, I generally run, you can run this process for the full year, so you have 12 months worth of data, the prices to put in. My rule of thumb, or what I encourage people to do, is only run it through the current month. So here we are in August, basically, the end of August. Only run the LOCM through August. Because what happens if you run it through the full year and then there's later sales that take place and the inventory goes to zero, that lower cost of market entry, the initial lower cost of market entry is still in the system from when you ran it in an earlier time of the year. So I encourage just running this through today and not trying to move forward, not trying to create this entry for the full year. Norm?
You're going to show all the monthly numbers in your future. I mean,
yeah. This screenshot is just a single month, but we can expand that to show the full 12 months of the year.
Right. You signed it by period,
by month,
by center, by project.
This is by finished goods project.
Mm-hmm. And going back to your setup screen, just to reiterate, somebody spelled up 37,100 is used for both the lower cost of market offset account and market offset account.
That's the way I have it set up.
Yeah,
Yes.
and the third, those are all actually three accounts that you wouldn't have in standard, or two accounts used three different ways that you wouldn't have in standard clips. Those are all unlinked accounts.
They're all unlinked accounts,
Yeah,
correct?
because they're just going to the balance sheet. So there's no. Okay.
So I have this module, Daryl, in our FBS, but I'd have to go create these accounts to make this work because I haven't used this before. We haven't used this before. So.
Yeah, most likely you will have to create them.
Okay.
Okay. So there's two accounts. The WIP inventory to lower cost of market is one. And then there's another account that I call value of unsold inventory. And we need this second account for a cost analysis reports. And I'll get to that in a minute.
Look at livestock.
Okay, so livestock would work the same way.
1,030.
Okay. So again, we put in the market value, creates this lower cost of market entry. And again, the balance sheet is reflected from stored crop or from growing crop to stored crop. Okay, going through the year, now we're out into December, and thankfully we've gone from 250 to, I think I put in 350 for market price. So instead of a $16,000 decrease, we now have a $40,000 gain over cost. So I have that plugged in up in the revenue side as an adjustment to revenues. But I also have this inventory adjustment down at the bottom is minus 158,000. So all of a sudden I'm creating confusion of having a revenue inventory adjustment as well as a cost inventory adjustment. So yesterday, I don't know if you guys know, when Todd was online with the Farm Financial Standards Council, I asked the question of what's the proper handling of inventory adjustments. And from a GAAP perspective, and I know I talked with John McNutt last night about it, his perspective was all your costs should be run through the expense side, through the cost side. And then John even thought, if it's a lower of cost of market, that adjustment should run through cost. Then I asked how he would handle the situation of when the market is above cost. Well, again, according, John lives in the GAAP world, so he doesn't account for that. From his GAAP perspective, he doesn't account for that difference. But I go back to where the Farm Financial Standards Council is. How do they handle these inventory change numbers? Well, the latest document that I got my hands on, I saw that inventory change up in the revenue section. Okay, so we've got some distortion and differences, and as you can see, I'm looking for counsel. I'd like to have some guidance and clarity on the best way of handling these inventory change numbers. Because in a real life example, I see $2-3 million numbers down in this inventory change. And what do they mean? And what do they reflect? I'd like to find a way of simplifying that. The other issue is where we handle these market adjustments is how it might affect our ratios. And again, with my conversation with John last night, if he runs his adjustments through the cost side, well, that's going to affect your operating expense ratios. So I think we need to be careful on how we do that. And as we go through it, we need to, I need to better understand the best way of doing it.
You're way ahead of council.
Well, I shouldn't be, Norm. So another type of year-end adjustment that we need to think through is accrued interest. And I generally run those through at the accrual level as a journal entry, accrued liability against an expense. And I do try to do it a reversing entry on that. So you put it on and it comes right back off at the first of the year, the next day. That way it's taken care of. But if final dollars are known for these year-end adjustments, property taxes would be an example where we know the final dollars. I encourage putting those on as accounts payable because they need to stay there, and you'll have them available when you do your property tax payment. So that, those are just two types of accrual, so it depends on whether you run things through the accrual as a accrual journal entry, or you run through things through as a accounts payable or receivable. It takes communication between your bookkeeper, the people in the office, as well as the ownership and the CPA. So another adjustment that that we make it quite frequently is our market value, especially on land. And in this case, I just have some equipment and then a year's worth of depreciation and some land. Well, Joe showed this to his Uncle Fred. Fred said, well, I think that land is a different value now. And I for sure know your equipment hasn't depreciated $11,000. So how do you make adjustments? Whoops, what did I do? Okay, there we go. So one way of making an adjustment is at the market level, level 4, and I go against the same ledger account as the equipment, and then I use an equity account to offset the difference. And in the next discussion, we'll handle depreciation in a different way. But this is the way that historically the way that I've done it. So when you put that journal entry in at the market level, you can see that we've increased our fixed assets. We've zeroed out accumulated depreciation because accumulated depreciation doesn't belong on a market value statement. You don't want to see it. So what are the best practices for report levels? I think, again, when you run the report across the different levels, you got the cash, financial, management, accrual, you'll start seeing, as you get into this, you'll see issues and things that need to be cleaned up. Well, the only way I think is you've got to start out the base level. You've got to start at the root cause level. So always start at the bottom. So make sure your cash level is correct, and then work yourself up through the accrual and up to the report level. Because if you make an adjustment at the report level where there's source problems back at the cash level, then you've got distortions throughout the system. And it just makes cleanup that much harder later on. And then on the higher level, I encourage the use of reversing journal entries. That way, if there's changes at the cash level, it's not that hard to go change the accrual level, reversing entry, and it just kind of works itself up through the system. If you don't use reversing entries, then you're always, the lower level adjustments, you're always making changes up the ladder. And then prepays, and again, it comes back to how you want to handle from a tax reporting perspective. I've had people that their focus at the end of the year is go out and do a bunch of prepays, and I want to get them recorded as an expense because that's the way they think of it in terms of for tax reporting. So in that case, we run those prepays as an expense, and then we move those dollars back up at the accrual level, back up into a prepaid account, and then I reverse it out the next day. That's if we don't want to manage the prepays. But most of the people I work with, or all of them now, my encouragement is when you make a prepay, is to book that at the cash level, and then you can monitor the vendor balances as those invoices come in. I think that's the best and safest practice. Best practice is to book that prepay as a prepaid asset, and then as the invoices come in to offset it against the asset account. Pioneer seed is traditionally a challenge for me. Everybody goes out and orders seed, and they either take early pricing or pay January 1st, whatever. So is it best, and you know what your seed inventory is, when you go out and make that prepaid, you identify what seed lot you're going to be buying. So should you record that as an asset, or should you record it as a seed expense? Because how many people, when they order seed, actually take delivery on that same seed they ordered? Yeah, it's very limited. So my encouragement is on like pre-pioneer seed, when you really don't know for sure what that final delivery is again to record that as an asset, and then when you get the actual invoice in, bring it back in as an expense. But pioneer seed, they're always a battle to work with.
But you're doing you're expensing it
From tax. Okay. Yeah, if you don't want to manage your vendor balances, but if you, to me, managing those vendor balances is paramount. It's important.
It's never when they when the delivery comes, it's never one-to-one. Even to change varieties, the prices, there's discounts, there's a whole bunch of things that it is technically possible to back it out. You got to back it out exactly the same price you bought it. So that's probably a good example of keeping them in just general.
Just as a general prepaid expense. Yeah.
Match it against.
Yep. Okay, moving a little deeper into the reporting side. And I want to focus on the cost analysis, and both livestock and crop reporting is about the same. But first of all, from when I was involved with the Farm Financial Standards Council, they always like to segregate or identify cost centers and profit centers. So these are the reporting formats that the council, in fact, Todd presented these yesterday, where we have a cost center and we have cost centers. Profit centers is basically the finished goods or the marketing center. And then it just has a field level total dollars that's rolled in. So we don't see the detail of fertilizer, seed, chemicals at the profit center level. But over on the crop side, obviously we can see all the cost detail, but we lack the revenue that was associated with that field. Okay, and as I was going through this, or when I first was trying to create these reports, it created a lot of confusion, and some of the clients I had, they were, they didn't like this dual style report. They wanted to have one report that had both revenues and costs. So introduce you to, well, first of all, I'll just go through what a cost center, a profit center and cost center report might look like. But there's issues for WIP, what I'm going to call WIP-based reports, or project-based reports, group reports, non-WIP reports. It's like we showed on the income transaction plus income statement. Those WIP lines may have a different value. If they're sitting in your WIP inventory, they're not going to show up as an expense. The same holds true on cost analysis reports. But there's lots of questions on how to run crop or livestock cost analysis. How do we match report levels? Then mid-cycle reporting. If we don't sell our crop until July, but I can for sure, July of the following year, I can sure tell you that everybody I work with wants to see a result of how that field or how that crop worked at the end of the year, if not before the end of the growing year. So there's issues with mid-cycle reporting. And here's an example of just a simple year-end reporting where we have an unsold inventory. We have that 350 in, and then our we have just a blank, a single number of field cost transfers of 279, and that's a basic profit center report. But the way FBS, when we just run it by marketing center, we lose the detail on acres. If we go over and look at a mid-year report, where we start having some grain sales and unsold inventory, the dollars at work, got the dollars to work right, but the denominator doesn't work right on the per bushel. So that's always caused some challenges for me. So on the cost center side, again, fairly nice looking report. Have all the costs by field or by center, but if we was to look at that same report before harvest, we have some of these WIP adjustments going in there. And what do those really mean at the cost center level? Again, we can probably define the reports a little different, but that just creates additional complexity in the number of templates and when to use what template and not. So introduce you to sort of solve this problem. Twisted Norm's arm to create a special report called a revenue by field report. And basically this is a combination of a finished goods marketing center as well as the cost center at the field level. So by doing all this and using that value of unsold inventory feature, this lower cost of market also creates a entry called value of unsold inventory. And basically that's just a monthly entry that's put in at the end of the month. It just reports the value of that inventory at the project level. The lower cost entry that we showed earlier only affects the center level or the WIP level, but this entry affects the project level. So what that allows us to do is we run this option 9 report. It allows us to see what I call a crop revenue by field. So the first set of columns is your overall set of crops and finished goods centers, and then the columns to the right are your individual fields on a per dollar per unit and per acre basis. And this report is satisfied a lot more of my clients than what the FSFC is recommending. But it's kind of a combination of both profit and cost center reporting. So the key behind this is that the dollars that's sitting in the finished goods inventory, those dollars are allocated out within the system based on bushels harvested. Okay, on the livestock side, this would be equivalent to the user-defined report, but obviously there's no allocation of what's in the group is the dollar, is the dollars that's posted there. There's no common marketing project. So this is kind of the final product that we generate from a crop cost analysis, is this field by revenue report. And this report works well for any time of the year, whether or not it's at mid-year or mid-cycle or at the end of the cycle. So this is kind of my go-to report on the crop side.
So can you do this only works on a project basis? And I've got one field that goes into marketing projects to prorate the bushels, or I got to have all production projects and the marketing project to get to match up the quantities?
Yeah, when you run this setup, you include both the finished goods marketing center as well as the production centers. So you put both centers in the system.
Okay, so I just select the centers on, and that gets it, and it does projects. And so you're seeing each field across there?
Yeah. Yeah, over on
the marketing center.
Correct. Yep.
Yeah. So you'll see it'll assign the same value per per bushel of unsold inventory for each.
Yeah, if there's any dollars that's posted into the marketing center,
Mhm,
gets allocated proportionately to the various fields at the same rate.
mhm.
So in this case, I have 425 as my unsold inventory. So that same 425 is posted across all the different fields.
Mhm. Right, right. I mean, this is the holy grail of reports, but you have to have used the lower cost of market to establish that
Correct.
value of
Yep.
unsold inventory. That's the reason. Yeah. So this is when you can't wait until the last bushel is sold to see what you're doing.
Well, yeah, Randy's not going to wait until mid-July
Yeah, yeah,
to see his cost analysis.
yeah.
I mean, okay, so the examples that that I've provided is more crop related. On the livestock side, the concept is the same. When you're dealing with pigs, where you have transfers from nursery to finisher, that creates even more confusion, complexity, especially at the profit center level. I struggle with the traditional cost analysis at the center level. So on the hog production side, I generally go right back to the smart feeder user defined reports, which is equivalent to the project report at the crop level, a non-whip report. Closed, yep, closed, yep, definitely closed. So where we're at for time here, but in summary, FBS report levels, they're confusing, they're complex, they're hard to manage, but it offers so many reporting opportunities. Being able to report cost basis as well as market basis in the same financial statements, financial reporting system, to me, that's critical. And that's unique, one of the uniqueness about FBS. The lower cost of market module is vital to get to this point, at least for the inventories. And just encourage you to make sure that you have that installed on your system, because it often doesn't come on a normal install. And then, as usual, I always have ideas for future development and future efforts. As we get into this and we start making these kind of adjustments, managing the fixed assets at market value, especially if we want to do it by individual pieces of equipment, that just becomes a cumbersome process. And if there's ways of automating that, it'd be nice. The WIP change report, I didn't get into that very deep, but basically that WIP change report just shows a listing of all your inventories and then valuation at cost. But we really need to expand that to a market value level, because that's what I'll provide to the bank, is a schedule that matches the balance sheet. And then terminology on the cash exchange. I'd really like to find better terminology than what we have, and better ways of managing that. I don't have I don't have good ideas, but I know that causes confusion with especially first-time users.
Unadjusted cash and true cash.
Yeah. And I like that modified accrual concept, because that's kind of what it is. Yep, WIP change needs to include market value. Okay, with that, I think that's all I have. Are there any questions, or pretty fast dive into report values or market report levels and impact on reports? But that's what I have.